Volatility is the statistical measure of dispersion of returns given a security or index. Now, what does that mean in non-Investopia terms? Basically means it tells you how much a stock or index is going to move over a specific period of time. And so I'd actually like to ask, and there'll be a test later, don't worry, pass out some scans. No, kidding. Show of hands in the room, how many of you are familiar or know what the VIX is? Quite a few. All right, now if I were to call on you, how many of you could actually describe exactly what it is to me? How many feel confident? Not as many hands. So coin the fear gauge or fear index. The VIX is the market's benchmark for measuring volatility. It represents kind of the market's expectation for how much the market will move over the next 30 days. So VIX at 10, you would expect the market to move, roughly up or down 3%. VIX at 30, we're now talking about an expected move closer to 9%. But the important thing to remember is the VIX not predicting market direction, it's just predicting how much the market will move. And so if we look at the current market, the S&P 500 is trading at roughly 3,000 record highs. And the VIX, I think right now, as of the close last night, I think it was 12.5. I think it might be up a little bit today, so call it 13. That means right now the market is predicting that the SPX, or the S&P 500 index, is going to move approximately 4% or 112 points over the next 30 days, which seems like a decent move. And so another show of hands, how many think we're going up? Some optimists. How many think we're going down? How many just don't think we're going either direction and don't know? Anybody? Smartest man in the room right there. And so the creation of the VIX, the importance was giving visibility into what the market sentiment was, but visibility is only so useful. How do I monetize that visibility? And so that's why in 2004, Cboe created tradable VIX Futures. So now the market participants not only had a way to look at the expectation of volatility, but they had a way to trade it. And then, therefore, could use this product to hedge risks as part of their portfolio. So the VIX tends to be inverse correlated to the market. So market's up, VIX down, market down, VIX up. And so people can use this type of product to mitigate risk as part of their larger portfolio. And so an example of that would say a pension fund. Pension funds have to have money available for disbursements throughout, basically monthly. And so if the market goes down and the capital at risk, or the capital in the pension fund is now under risk, you can go long a VIX future, say, and so the money you'll make by the VIX future increasing as the market sells off can offset losses in the larger portfolio and help you have money able in your pension fund to make the disbursement payments. And so now fast forward, and it was 2004 when the VIX came out, fast forward 2 years, and investors are becoming more and more sophisticated. Complex derivatives are beginning to trade. You have SPX options that allow you to hedge directional moves, and you now have VIX futures that allow you to hedge volatility. But what happens when volatility itself becomes more volatile? What can you do? Can you hedge this risk? And that's why in 2006, the SIBO introduced options on the VIX, providing market participants a way to hedge the volatility of volatility. So now we're talking the second derivative of the S&P 500. And so prior to these being created, these products, the only way you could trade and hedge many of these portfolio risks was through a bank. You would call up your bank, you'd explain the kind of risk you need to hedge, the bank would structure a product, and you would trade it over the counter or OTC bilaterally with the bank. And so a bilateral transaction is a lot like if you were to, say, make a bet on a basketball game. The ability for you to collect on that bet when you need to is based on the creditworthiness of the person you made the bet with. And so in doing that, it was basically, it's all based, OTC is truly based on credit risk. When I need this most, if I have a hedge on and the market tanks, do I have the ability to collect on this hedge? And so in general, I think banks are regarded as having pretty good credit. But what we learned in the collapse of the market in 2008 and the Lehman collapse was that having centrally cleared products traded on an exchange was very, very beneficial. And so now that all of these products are traded on the exchange, where does the liquidity come from when it's time to actually make the trade? And so liquidity providers or market makers that stand on the floor, they're there to form a market. They're there to basically create a place where a person is willing to buy and sell any particular derivative. And so for the first half of my career, that's what I did. I was a pit trader. I wore one of the goofy jackets. I went down to the floor every day. I stood in a trading crowd and basically made markets. I got to see firsthand the impact of liquidity, or more importantly, when there's a lack of liquidity in the market. And so I was in the S&P pit when the markets reopened after September 11th, and I was in the VIX pit when we had the flash crash in 2010, and where the VIX doubled over the course of a few hours. And so some of those experiences, I'll use September 11th as a good one. I hadn't quite gotten down to the floor yet when the incident happened, and markets were shut. I think they were closed for roughly a week, I think, after September 11th. And that first day we reopened. All of the traders are down there. We probably got down there 45 minutes early compared to what we normally did, waiting for this crazy event to happen. And the minute the bell rang, if you've ever been on the floor of the exchange, there's timestamp clocks and telephones, and it was just silent, nothing. You didn't hear anything. It was the most eerie time I think I've ever been on the floor. And then all of a sudden, it was maybe a minute into the day, which is normally kind of an eternity. All of a sudden, the phone rings, and one phone rings, another phone rings, and it just starts to build. And before you knew it, you couldn't hear a single thing on the floor. It was just almost utter chaos. Markets down 5%, 10%, people yelling and screaming. And it was pretty much, probably an instance I'll never forget in my career. And so it also kind of highlights, so many of you are probably wondering, with the advent of computers, are trading crowds really necessary anymore? And my answer to that would be most certainly they are. In the option trading world, it's really common to have very complex strategies, sometimes things that have legs of 10 or more options. And with that given complexity, it's very useful to be able to have that kind of face-to-face negotiation between a broker and a trader. They can change things on the fly. They're allowed to really get a feel for what the market is, how they can basically trade this risk. And so additionally, when there's instances of extreme market dislocations like September 11th, market makers are on the floor and they have an obligation to make a market. And that's really important because no matter how crazy the market gets, they have to stand there and they have to tell you, yes, I'll buy it here and I'll sell it there. And so if you think of that in just a simple plain terms example, like think of something like Chipotle stock. And you love Chipotle stock. My wife eats there all the time. And you want to do nothing but buy the stock. And so you're a market maker in Chipotle stock. You want to buy for I think it's 7 something now, but say it's 600 and you make a market, I'll be 600 at 605. Not a realistic market, stocks are tighter, but let's say 600 at 605, and a guy comes in and says, I'll pay 605. Well, no matter how bad you want to own that security, you're now left having to sell it. And that's kind of the function that market makers provide. And so in my career, as kind of my job progressed, I took on more responsibility. I left the floor. I became a portfolio manager upstairs. From there, I moved on to be to basically head up a global volatility business, as Spencer mentioned, at DRW. And so now you're probably asking, why go to an exchange? And so at a high level, kind of the ability to create new products and kind of shape how markets trade risk was very, very appealing to me. That combined with almost 20 years of trading and managing the exact products that I'm now responsible for further developing really seemed to make sense. And so I made the jump, and I have to admit I've been happy thus far. And at Cboe, we're really working on some really exciting projects. Things like credit volatility products, rate volatility products. We just heard about clearing. We're working on clearing solutions to allow people to trade more capitally efficient. And basically, all in all, we're just trying to solve problems. And so my first project even, right as walking in the door, was to basically revamp the entire VIX settlement process. Something that you can't afford to get wrong given the significance of what the VIX is and being a global benchmark. And so being able to use the experiences that I've had and pour it into kind of redesigning this process has been extraordinarily useful. And so I guess we talk about career advice. What sort of career advice could I give? I won't go as far as to say find something you love, because I think that's a very high bar to set. But I would say find something you're passionate about and really submerge yourself in it. Learn as much as you can in the process, and if it's something you decide you don't like, switching's fine, but when you do find something that you like, really own it, become it. In trading business, you see, a lot of people that enter with the idea that they're going to make a lot of money. And it's true, trading can be extraordinarily lucrative. But when people, the people I saw that entered the business for those reasons, that lacked the passion, generally got washed out very, very quickly, because it's that passion for what you're doing. And that's what's going to power you through the all-nighters. That's what's going to keep you from banging your head against the wall when somebody drops a last-minute project on your desk and gives you a due date that is almost unrealistic. And so, in closing, I think that's the biggest thing. Search and try to find that one thing that you're passionate about, and then learn everything you possibly can about it, and the rest of it will fall into place. So, thank you guys for the time. Appreciate it.
We read dozens of news sources, so you only have to read one. John Lothian News.